Good morning. I'm Scott Forcino, an associate broker with Real Brokerage, based in the New York metro area and Florida now. I founded PlugIntro so people can meet who they should know, both in business and specifically in the real estate industry. Made a lot of great friends and I have a lot of respect for some of the practitioners. And Jason Ramirez hosts his own PlugIntro platform where the agents that he invites and works with and co-hosts have a great opportunity to maximize their exposure and give others the gift of introductions. And Jason's doing a great job, long time professional. Jason, good morning, and let us know what bank you're with and how you're finding it, and about the market and about how you work with clients and referral partners, please.
Morning, Scott. Good to be here. Thanks again for the invite. I'm with TD Bank. Again, like two months so far, and it's a slower market. Obviously, we don't have to get into that. That's just obvious. But this is a bank that has a big product line, good culture. They're strong financially. It's where I want to be. As I plant seeds along the way. When the market does turn around, and it will turn around. And when it happens quick. And you really want as much exposure as humanly possible. So when it turns, you're the first name people see. And I've had a great deal of success, 19 years in the business. So I see, this is another boom will happen. You just have to kind of ride out these tough waves right now.
Why do you think a boom will happen? I mean, there's so many factors to consider. What do you consider?
So, what you needed to see, one, was interest rates stabilize. That's been happening. We've kind of settled on a certain area in interest rates. And I've said before that activity will formulate around the stabilization of interest rates. When they keep when they keep jumping up and rising, people get a payment shock or an interest rate shock, and then they get panicked. So future homeowners don't know what the rate is going to be 3 months from now because we've had a constant climb. That being said, on the other side, resales have been slow simply because people have 3%, 4% rates, and where are they going? They're not going to sell and jump to a 7% just to that's not necessarily an upgrade or a downgrade. If your payment's going to be this, it doesn't make sense to make the jump. So resales have been very slow. Now with inflation being where it is, you've had new construction being the primary, represents 35% of the sales right now, and climbing. But there's been, new construction itself has been, hasn't been as robust because of the higher cost of goods. So as inflation stabilizes, as rates stabilize, you'll start seeing activity formulate, and then once that happens, you'll have another run in housing. Now it happens quick, just like it went from really fast. Activity went from aggressive activity to next to nothing. The turn happens quick. It just and you want to be ready for that turn. That's why you have to keep grinding and keep being available and planting seeds.
That makes sense, and providing value. And I don't like the misuse to the word value, because I oftentimes, when I hear provide value, that means I'm doing my job, and so is everyone, and that means you get to compete. And what I consider value is doing something way beyond your role, and that means if you can partner with a referral partner or a client and give them something that's going to help them in their real life. I mean, your life is not a mortgage. Your life is not your kitchen. Your life is work and recreation. So if people can gain exposure to income potential or sources or friends, or even learning about where the soccer game is, or learning about July 4th festivities, that is, I think, leaving a much bigger impact, because mortgages you can search online, you can ask a friend. I think you got to do so much more than your actual job, performing your role.
Yeah, I think it's more, you have the customer buy into the way your philosophy, your approach. Mortgages itself is it is a scary, if you're new to it or you've done it once or twice, it's a giant move. It's very, there's a lot of moving parts. It's very tedious, and you really need somebody to orchestrate that for the customer, kind of basically calm the waters, hold their hand, as they go through the process. And, nothing's ever really smooth, simply because there's too many moving parts associated. There's too many third parties involved. There's too many entities, that are involved in the transaction. So, when you have a first time home buyer looking to purchase a house, and the first thing that goes wrong, they get panicked. So you have to be able to navigate them through the waters. And that's something that no website can give you, or somebody new in the industry, that came in just because there was a boom. They can't offer that. They don't understand. They don't have a philosophy. So that's, what I try to do. I try not to just be a customer service guy, so to speak, where, I take your application and I put it through and collect a commission. We don't do that. We try to navigate you through the waters, and hopefully you have a good experience. And, and then from that point on, you're a customer for life. You refer me your friends, family, your other transaction, if there is one, going forward. And that's how you build.
I agree. When I speak to a realtor, I focus on the realtor side. When I speak to a lender, I focus on the lender side. So I really go left and right, apples and oranges on all these calls. But if you think about it with the realtor experience, if you are a seller and you find a buyer quick, the realtor's out of it. If you're a buyer and you make an offer full price and you get it accepted under whatever market you're in, the realtor did their job. Now it's all about you, because title's title. Title is just a blood test. It's just your blood pressure. Are you this or are you that? But you have a lot to do, and not everyone is equipped with essentially the mortgage interest rate doubled in relatively short, under 18 months.
Yeah.
In a year. Yeah. In a year. Okay. So, that took, I'm happy I was not in that position, because now if you think your ducks are in a row, now they're not. And that's disappointment. And there's probably anger, and there's people with anxiety. Wait, I missed the boat, or any of these things. So they really, really need to be comfortable with the professional that they're with in this market and any future. What are the possibilities? I don't know. Do you think there'll be any appreciation? I do not think there'll be ever appreciation again. It topped out.
Appreciation in terms of home values?
Yeah, will it go up anymore? I think they haven't gone up, and they're staying. There are pockets with all cash deals, but other than those,
I think for sure there'll be appreciation. Now, will it be 12%, 13%? No, but homes do go up in value 100%, and it's going to be depending on certain areas of the country, certain pockets of the country. If you focus on New York, yeah, we're expensive. But if you go to California, these same houses, especially on the West Coast, the same homes that are priced here, they're double over there. So yeah, there's a lot more room. There's a lot more upside. Now, the question is pool of buyers. That's really the question. To your point, I think they'll go higher because you have another millennium. You have a generation of the millennials coming. That's going to be the largest generation of home buyers coming in, and prices will go up. It's not going to be double digits. It'll be single digits. It could be 3 to 5%, but they'll definitely go up. And as customers are more qualified than they ever have been, foreclosure rates right now are at the lowest they've been in decades. So, they'll be stable. The home prices will be stable and rise. So you won't see, much of a downturn in the housing market. So yeah, it'll go up. It will stabilize and go up, but it's not going to be double digits like it once was, like COVID, where there was just a run on properties. That's not going to be the case.
Yeah, that's an interesting phenomenon. But I appreciate your point about millennials, and they certainly have a lot. We know one thing about millennials, and even the next generation. I don't know what they're called, because the millennials could be in their 40s, so they're not kids anymore.
No,
the next group, I don't know what that is, but you know what? You got to realize something. Gen Y.
No,
Okay,
Gen
so
Z, Gen Z, Gen Z,
Gen
Gen Z. I'm
Z.
sorry. Yeah.
I sound like my dad here, not knowing these things, but I got to tell you that there's a lot of indications where these people are not doing what people did. All of the trappings of, let's call it adulthood or advancement. Kids aren't getting married. Kids aren't buying cars. Kids aren't leasing cars. There's no such thing as joint accounts. There's really no such thing as savings. There's such a movement towards urban with public transportation, the greening concept. This group is doing things extremely differently. There's the gig economy. I mean, I don't know how you respond to those applicants who are the gig economy. There's kids are more free agent, mercenaries with their laptops, moving here and moving there. A lot of them I know are not even staying in the job 2 years, which is usually a requirement, if I'm correct, as you know. So are you seeing any challenges where the profile really has shifted?
I don't think the profile has shifted as much as like you might think. Even if they jump around from employer to employer, you don't necessarily. This is not with every bank, but this is with most major lenders. You don't necessarily got to be at one spot 2 years, as long as you have a 2-year history, and it depends on the career. There's a lot of variables that go into that decision, so it's not just that black and white. What you are seeing though with this generation is a lot more research. So when they come to you with some research. A lot of it's Google search, so that's take it for what it is. But you're seeing more and more research. People are trying to do more due diligence. That's what you're seeing, as opposed to Gen X and even baby boomers who kind of just already knew what they wanted. They just wanted you to give them a good deal and just move on. So it was a little easier to work with that demographic than it is with the millennials, because they do a lot of different research. Also, communication is different. Half of them don't even want to speak on the phone. It's more of a text message,
no question about that.
email.
No question.
So
Okay.
it takes what could be a 5-10 minute conversation and extends it through 2, 3, 4 hours long. And then as you may know, which some stuff gets taken out of context when you text somebody. So it extends the transaction is really what
I know these banks are, you're using portals, so it's not even the old days fax to your processor. Now upload your financial docs, your bank statements, your W-2, and you pull credit. I mean, someone just uploads electronically, boom, 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 file to file, and you could have an applicant in minutes.
Oh yeah. Yeah, but like at the end of the day, like, people are still needed because there's too many people involved in the transaction. So people are always going to be needed. The ability to streamline the business is a lot easier nowadays because you can just upload. You can pull credit in seconds. The ability to just scan docs and email, and people don't even fax anymore for the most part, right? So
No, it's gone.
so you could definitely, the ability to streamline the process is definitely in place. That doesn't necessarily mean the process is easier. Just because, again, there's human beings at the other end of these transactions. They haven't, not the process itself hasn't been replaced with computers and machines, because there's still people there. The ability to move the information is what transferred. So, those are the subtleties. And again, there's so many rules and regulations. Sometimes these transactions can take a lot longer than normal. And especially since not everybody's equipped to pick up the phone and have a conversation. It extends the conversation. It extends the transaction.
Right. Well, everything else is done without a conversation, and the conversation with this younger group of people, directness is now seen as confrontation. So even a directive, even something like a requirement, something that is somehow a burden. Don't get me started in a weird. I'm that get off my lawn guy. So
yeah. I'm with you.
But that's a little bit more like in the real estate transaction. It's more yes or no. In the mortgage, you're looking at 31 Baskin Robbins flavors. And I like that, yes or no. There's no middle ground. It's not a maybe. It's a yes or no in the house or the purchase or the price.
Yeah.
Which
It's
is,
not yes or no. It's like Common Core math, right? Like 2 + 2 is not 4. It's like, why is it 4? How is it 4? And what are the variable? It's not the same. It's very wild.
I
It's very
know.
weird.
I've done that. My daughter's going into seventh, and they did these blocks and the 4 10s and the 4 1s. I go, just do it in your head. And if I'm in the car, do stuff like magically in 1 second. They're like, how'd you do that? I go, because you just think about it. What are you talking about? All this process. Just think about it. So yeah, here's something I want to ask with you. And I think no one's talking about this. And this is always in this part of my head thinking, let's say you have a normal debt to income, or even like you described 1 or 2 times before, the high back end debt to income person. How do these banks underwrite these loans with the awareness that taxes and insurance are surely going up? Florida, there's double the insurance. So how are they writing that in good conscience? He's a cop, she's a nurse. There's no side bartender business. If they know you qualify at this DTI and they're aware in the next 24 months, 36 months, it's going to be, how? Tell me how that is thought of.
Well, they're looking at it. I mean, they're looking at it in a couple of ways. Like, if taxes and insurance go up, they're looking at his incomes should obviously be going up as well. So, that's, a bank can't, they like what you're saying is, sort of project like a turn down, like, because you're not going to be able to afford this in 2 years. I mean, they just don't do that. They don't play
I
crystal
know,
ball.
but you just mentioned wages, and wages are not advancing to the extent that taxes and insurance are.
I
Those are
mean,
rapid.
there's always ways to, you can grieve taxes and you can just shop for cheaper insurance. That's the beauty about capitalism, right? You can just easily shop for cheaper insurance. It's out there. It exists.
I hear you. Not all places, but I hear you. Look, we're dealing with the summer and hurricanes and tornadoes and places of devastation.
Mhm.
I just heard that 2 major insurance providers left Florida, leaving people high and dry, no pun intended.
Yeah.
And then there's an amazing point I heard on a video the other day. I don't know why it never crossed my mind. They were talking about renting, and they said, when you rent, that's the most you can ever pay. There's no escrow account analysis. There's no good news. We went up $100 a month. You have nothing to say about it. You are topped out. You agree to the rent, whereas there are factors in play. If you need a new school, or if needs new roofs after Hurricane XYZ, your mortgage payment right now is the least you'll ever pay. It's the least you'll ever pay. It won't go down. It can only go up. So we're talking about the most versus the least.
I mean, if you rent or lease or whatever, that's money gone. If you own and you're paying a mortgage, that's an investment. You're investing in your home, and that's an appreciating asset. So I mean, it's really like apples and oranges.
No, I agree. I agree.
There is no. If you pay $4,000 a month in rent, that's the most you'll ever pay. Yeah, but you're not making any money on that. You're not gaining any. You're not gaining any equity. So it's definitely an apples and oranges approach.
I hear that. I mean, of course, there's the tax benefits, and people say when you're paying rent, you're still paying a mortgage, just not yours.
Exactly. Yeah, you're paying somebody's mortgage, and somebody's making money on that. So it's an investment. That's the thing with a home. It's also an investment vehicle. Outside of a place where you want to hang your hat and raise a family and so on and so forth. It's also an investment vehicle. That's why it never made any sense to me during, just maybe changing gears a second, never made any sense during the 2008 crash, where people were just letting their homes go. Not that they couldn't afford it. They just didn't want to pay because they were underwater. I never understood that. I'm like, but this is an investment that's ultimately going to pay off. So why would you just purposely let it go just because you're 50 G's underwater? Granted, if you couldn't afford it, that's one thing, another conversation. But if you were just there were people that just like, well, I'm 50 grand on the water, I'm gonna do.
Yeah, I know. And those were they were called these zombie foreclosures. They would just leave. And I know a specific neighborhood nearby here when they were trying to give away great places and people were not properly advised. And I think that also is some of these states are not attorney states. So the foreclosure can race through, the eviction can race through. They didn't want to suffer that. Where in New York, between having the right attorneys on your foreclosure and your eviction, you and I both know you could buy a lot of time.
Mm-hmm. Yeah. Yeah. I mean, that's those were the differences, like it was a crazy time, the zombie foreclosures. Yeah. I haven't heard that term in a while, but yeah.
Right. Zombie. And they had a big problem because in a place like Florida, where if it's not heat, it's not cooled, that it could be mold in days. A house could be destroyed without HVAC, without AC.
Yeah. I mean, now people can't get enough of homes. There's not enough homes out there, so what a serious change of events in 15 years, right? You went from
based on the 2008 and 2009, and it's amazing we're talking about that. I used to say that the fallout from 08, 09 would be done by 2020. I used to say, wait, this is going to go to 2020. And now it's 2025 close, right? You're a year and a half from 2025. So based on the 2008 and 9, the lowest incidence, I should say, of home building in American history was 2010 to 2020 or 2019. No homes were built compared to, the baby boom and all these others. So that's really where you could point to that crazy COVID seller's market. People didn't have choices.
Yeah, no, yeah, no, that's, when there's no new homes being built and demand is increasing, you're getting what you're getting right now. We're kind of in the middle of it. That's why, to what I was saying earlier, I think there'll be another boom ultimately, because, inflation's going to get tempered and homes are going to be built and rates are going to stabilize and you're going to start seeing activity. And once it gains momentum, it's going to be another beast. Now, here's the issue. Actually not an issue for people like myself, but, there's going to be a big fallout of people in real estate, mortgages, real estate agents. There'll be a big fallout. They'll be leaving, the business and going into other areas of work, or other fields. Right. So, once activity picks up again, there'll be a smaller pie, but there'll be less people requiring, trying to feed off that. So,
that's already started to happen.
Yeah.
It really has. There's another thing that's holding back the market. I'm sure you know this. People who are enjoying a 3.0 or 2.75 or 3.25 rate, where are they going? What do you? That's holding back. So I think even if you enjoy a lot of equity, that would be a tough pill to swallow if you buy something of the same price. What do you think of that?
Well, that's what's killing the resale market. That's why resales. That's why during the height of craziness, okay, resales made up 90% of the overall transactions, the purchase transactions. That was during the height of craziness, and new construction made up less than 10%. Today, new construction sales make up 35% of the overall purchase transactions, which means it's not that there's so many more new construction homes. It means that there's that many less resale homes because rates are so high. So where are people going? So to my point earlier, as rates stabilize, if you get into, let's say, I don't know, just picking a number, let's say you get into the fives, mid fives, low fives again, that person with the 3.5%, 4% may say, you know what, that's good enough. And they'll make the move, they'll make the jump, and you'll see.
I think you're right. You're right. And I also think, I think you're right. And I think one realtor said to me that was super smart, and it's a mastermind. They said, wait a minute, why are you complaining? You're spending the house money, at a gambling table, at a blackjack. You're playing with house money. You didn't go to work. You didn't save in a coffee can. You didn't do anything. You went to bed in your house and you got more money at the closing. So it's not like you deserve it or worked for it. So now if you're going to spend, if there's a higher payment, like you say, high fives, mid fives, even 6 or even 7, if you know better than I do, what a payment might be, what, $300 more a month, I'm guessing, if it's 3 to 6, 3 to 7, I don't know.
I mean, it could be like, a lot of variables there depending on loan size and
Okay. So yeah, I mean, but let's just call it 300, 350.
Yeah.
That's 3,600 a year times 5 years is 15,000. So to make a move, it's going to cost you 15,000 from your monopoly play money that you didn't earn. The house went up 25%, 20%, even 15%. So when you're talking about these kind of numbers, any house went up $300,000, $500,000 house went up to like 6 and change at least, right?
I'd say so. Yeah, that's
So
a good number.
that's 25%. So you can't spend that. You're playing with the house money. We're only about 3,000, 4,000 a year more. When you break it down, the rate, I mean, 3 to 7 sounds a long way. 3,500 a year does not sound like a long way.
That's why I've often used to tell people that rate, sometimes making rate the big measuring stick is a little bit overrated. You have to look at the payment itself. What are the differences, and can you handle it?
Right, but there's to me, there's apples and oranges. The person who's a first-time buyer has to be able to afford that. The person who just sold and they bought 2019 in a certain hot market, that's not the same person as qualifying. They just pick a payment and they spend their equity. And I know someone who doesn't want to do that. I said, I think that's crazy. You're using money that you were gifted, essentially. You went to bed at night. That's all you did.
Well, yeah, I mean, look, human psychology is, if they have the money now, it's almost like an entitlement, right? My house is $200,000, $300,000, $400,000 worth that much more. And then they want to hold on to it. They don't want to lose that money, and they don't want to sell and then go into another home, maybe a less of a house and more of a payment because the rate is so high. Like they don't want to. So I think it's more human psychology. That's why I'm a big believer. If rates just stopped going up, if they just stopped, and you got a 6% rate, let's just say, you'll just see the form. You'll see the activity start developing around that number. You'll just see it. But when you have the yields and mortgage-backed securities just jumping all around, we got hammered in the interest rates just 2 weeks ago. We were north of 7 on the 30-year again. I'm using the 30-year as a benchmark because that's just the most widely monitored one, right? And now we're back, depending on the situation, mid 6s, right around there. So we've had a 75 basis point swing in just the rate in a couple of weeks. So that's what you don't want to see. You don't want to see such volatility because people have no idea. People don't like volatility. They don't like volatility. They like stability. Which is why the 30-year fix is the most widely held product because it's stable. It's 30 years, even though people don't write out a mortgage 30 years. They don't write out a house 30 years. They've refied about 5-6 times in that time frame, So stability is what you need, and activity formulates around that number, whatever it is. And as rates come down, you'll start seeing it gain more momentum, without a doubt.
Well, yeah, I mean, look, I think this kind of professional insight based on your experience and your keen observation of the market and the conditions and what you see happen around you, I think it's so valuable. And that's why, with a platform such as this, where I was really, really careful to invite the right people and to say, this person has an amazing professional message. And I give you a lot of kudos for creating an audience of those people that can hire and refer you, and then inviting them so you control who sees what you have. It's not really what I call social media because it's yours, and the people who are invited enjoy the benefits of their own position. Local business media gives everyone a chance to promote their business. Thank you, Jason. We will be reaching you again, and I'm going to make sure we build up that local business audience around you and really benefit the agents and either create relationships with agents or enhance them.
Perfect. Thank you so much. I really appreciate all your time.
You have a great week. Thanks a lot.
You too. Take care.
Take care, buddy.